Welcome to our conversation on financial reporting. The focus of this session is to understand the cash flows. In the process, we will refer to the cash flow statement as prepared using the Ind AS 7. Cash flows are due to the receipts of cash and payments of the cash. But Ind AS 7 says the receipts and the payments need to be classified and presented on the basis of the business decisions, should be classified into operating cash flows, financing cash flows, and investment cash flows, so that it will enable us to understand the reason behind the cash flows. It is not enough to know that cash has gone up or cash has gone down. But why did the cash go up? Why did the cash go down is important to understand. Therefore, Ind AS 7, according to Ind AS 7, every company is bound to show the cash flows reflecting cash from operating activities, cash from financing activities, and cash from investment activities. Now, if you observe, the cash from operating activity is the operating receipts minus operating payments. Minus operating payments. Similarly, cash from financing activity is the receipts from financing activities minus the payments of financing activity. Similarly, cash from investment activity is the receipts from investment activity minus the payments of investment activities. So normally, whenever we say cash flows, we would like to focus attention on cash from operating, cash from financing, and cash from investment. But these are net cash flows. Net means receipts minus payments. So it is necessary to observe whether the cash has gone up over a period of time because of operations. Is the cash has gone up because of financing, or cash has gone up because of the investment decision? Mm. Now let us take one by one. So cash from financing activity. Before we get into cash flow from financing activity, let us understand this financing activity. Financing decisions relate to the decisions with respect to the sources of finance, debt or equity. When a company raises money, it can raise money through debt or equity. So cash flows affected by these decisions are called cash flow from financing activity. So under this also we'll have receipts and payments. The receipts are, as itself is very clearly visible, that may be because a company has raised money through issue of capital at par or at a premium or at a discount, but it is a cash inflow. Or a company can raise money through debts, through borrowings, through bonds, through debentures. So these are the receipts that a company during a particular period raises funds to do something. It can be for operations or investment. But at this juncture, our focus is on what is the cash inflow due to the financing decisions. Similarly, the relevant payments are the payments relating to this decision is maybe to reduce the capital, which is called buyback of shares, or maybe to reduce the debts, which is called redemptions or repayments. The redemptions and repayments and buyback leads to the reduction of the sources of money. The payments may also relate to the interest, a recurring interest on these loans, on bonds or debentures, or distribution of cash dividend on this capital. So we see a company with a consistent positive CFF. Positive CFF means the company is raising money either from the debt or equity. Invariably, you see that in a new company, in a new startup, you see that CFF may be consistently positive. But there is possibility that an existing company may be having a consistent negative CFF. And the negative CFF may be because of interest or dividend or buyback of shares. So therefore, there is a need to understand why the cash is moving. Where is the cash going? To do that, let us see the cash flow from financing activity of the one of the well-known companies like TCS. We can see that all through 5 years, from March 21st to March 25, the cash from financing decision is negative. But if you observe the reasons for this negative, a significant part of the negative cash from financing is because of the dividend distribution. Because of the dividend distribution. So TCS is one of the companies which have been regularly paying dividends, distributing dividend to its shareholder. One of the largest shareholders of TCS is Tata Sons. And Tata Sons is an unlisted company. TCS is a listed company. The other financing item, since this data is from Screener, so the other financing item includes the buyback of shares. The buyback is also money paid to the shareholders. So consistent negative CFF of TCS is due to distribution of dividend and return of capital to the equity holders. They have not borrowed money during this period. They have not raised money in the recent past. So significant part of cash is a distribution of profit or reduction of equity. Whereas Tata Steel, we can see that Tata Steel out of 5 years, 4 years has been negative. The latest year is a positive CFF because of the proceeds from the borrowings. The company has raised 23,000 crore during this year. What did they do with that money? That we will see in operating or investment. But at this juncture, CFF will tell us that the company has raised money, not through issue of shares, but through the borrowings. And they've also repaid small amount of borrowings. So the negative CFF of Tata Steel, we can see that because of the repayment of borrowings, that is reduction of liabilities, interest payment, and some amount of distribution of dividend. So the reason behind, the cause behind the negative CFF of two companies belonging to the same group are not same. The behavior of CFF of TCS and Tata Steel are different. It may be because of the nature of the business. So in order to understand the cash flows, therefore, India says, understand the cash flows by linking it to the respective business decision. Now we'll see cash from investment activity. Here, investment activity is the acquisition of assets, particularly the non-operating. That means the purchase of plant, purchase of the decisions relating to acquisition of PPE, property, plant equipments, the decisions relating to intangibles, decisions relating to investments. Here also may be receipts due to this investment activity or payments due to this investment activity. The receipts may be because of the interest and dividend received, or sale of PPE, or the sale of investment. Sorry for purchase by mistake written here. Is a sale of investment. Is a sale of investment. So we can see that the receipts from investment activity to a large extent due to the dividends or interests which are recurring in nature. And on and off, the companies may sell the property, plant equipments or sell their investments. And these are not their main operating activities. Their payments are obviously the acquisition of property, plant equipments and intangibles and purchase of investment. In case of financing decisions, the negative CFF is a reflection of dividend distribution or buyback of shares or interest payment. But here, negative investment CFI is a reflection of acquisition of asset. A consistent negative CFI is a reflection of growth. A company is growing. A negative CFI may be because of consistent acquisition of asset. Acquisition of asset may be of PPE or investments. Investment may be of equity or debt instruments. So by default, we can say that negative CFI is a sign of growth. Unless, of course, you observe there is a transfer of money to a shell company or a group of shell companies. Observe the composition of the negative CFI. Let us see the CFI of TCS. So TCS, they have been purchasing investments. We can see that. These are all standalone balance sheet data. They're also selling investments. Okay. So they invest money because the company is having huge cash sitting, cash generated from the business. The cash generated from the business, they do for dividend distribution and also investments. So the positive CFI, to a large extent because of the purchase and sale of investments. There is acquisition of fixed assets obviously will be minimum here or rather small amount because TCS is not into manufacturing. Whereas we can see that for Tata Steel, there is a consistent negative CFI. Consistent negative CFI. This negative CFI because of investment in subsidiaries and acquisition of fixed assets. So both are the signs of growth. The company is investing and assets are ability to generate future cash flows. So negative CFI by default is not bad. Negative CFI is an investment in assets. Let us now see another important cash flow, that is cash flow from operating activity. The core strength of the company comes from its operation. The cash from operating activities receipts is from sales, that's or services, or a collection from the customers or advances from customer. So advance from the customer is a liability because you have to provide, the company has to provide the service or have to refund the money. But the collection and sales are already for the services they have already provided or goods which have been sold. The corresponding payments are purchase of inventories, operating expenses paid, similarly advance to the supplier. Advance to the supplier is actually an asset because you'll get back money or it's you will get the asset to that extent. But observe, unlike the CFF and CFI, a consistent negative CFO is really a worrisome indicator. Because a consistent negative CFO means the business is not able to generate cash from operations. Is not able to generate cash from operations. Now, this approach of deriving CFO, Ind AS 7 says The CFO can be derived by an indirect method and direct method. This is direct method. Direct method means operating receipts minus operating payments. Operating receipts are sales, collections, advances, and operating payments are purchase, expenses, and advances. So operating receipts minus operating payments will enable us to see the actual cash flows. But Ind AS 7 recommends that CFO should be derived by indirect method. In indirect method, there's a question that it answers. Why is CFO different from PAT or profit? So CFO under indirect method is a adjusted profit. Here I'm taking adjusted PAT. It can be any profit. You can derive a CFO from by adjusting to EBIT or EBITDA or PAT. So what are those adjustments? Profit is derived by using accrual concept, matching concept, whereas the cash is actual. So the adjustments are related to this actual, accrual, and matching. And what are those adjustments? The adjustments are for non-cash items, non-operating items, and the changes in the current assets, operating current assets, and current liabilities. The non-cash items are like depreciation, amortization. Non-operating items are interest paid, dividend received. The changes in current assets and current liabilities, or operating current assets and operating current liabilities, arise due to accrual principle. Credit sales, credit expenses, credit purchases. So one can derive CFO from the income statement, even if cash flow statement not given, because of this indirect method of deriving CFO. Ind AS 7 says that indirect method is recommended. So most of the companies show CFO by using indirect method. For example, if you see, this is a cash flow statement of HUL. Cash flow statement of HUL. We can see that cash from operating activities, they have done adjustment to PBT, profit before tax. Adjustment for what? Adjustment for non-cash items like depreciations, non-operating items like dividend, interest, interest expense, interest income. These are adjustment. Adjustment to what? Adjustment to profit. For example, let me just pick up two items. Depreciation is added back to the PBT because while computing PBT, depreciation has been deducted. Why did we deduct depreciation? Matching principle. Interest income has been deducted here because interest income has been shown in the HUL's income statement, and interest is not an operating income for HUL. HUL is not in the business of lending money. So we need to remove that away to derive operating. Therefore, we deduct it. So one need to understand those adjustments. These adjustments are basically for the adjustment towards accrual and matching. Similarly, the operating and non-operating done here, and the changes in the operating current assets and current liabilities. Okay. The changes in current assets and current liability is a reflection of credit sales, credit expenses, credit purchases, or the payments. So almost every listed company is bound to show the cash flow statement showing CFO, CFF, CFI, and CFO by using indirect method. And you can see the cash flows, investment is not adjustment, it's a direct method. Financing is a direct method. So that is a cash flow statement. Understanding cash flows are very, very important to understand the health of the business. Let us take an hypothetical example just to derive cash flows. This is a hypothetical. So balance sheet is there, opening and closing, income statement is there, and cash flow statement, but not following Ind AS 7, all receipts minus all payments. The first thing that we will do is to classify this into cash from operations, financing, and investment. Operating, financing, and investment. So, operating cash flow, operating cash CFO, CFO is equal to, okay, CFO is equal to, let me just, CFO 199,000 negative. How did that happen? We can observe that, and this is a direct method. Cash sales, no sales. There is sale, but no cash sales. Minus the operating payments is a cash from operating activity. Observe CFO is negative when PAT is positive. Let that question be there at the back of your mind. Why CFO negative despite the fact that there is a positive PAT? Then let us see CFF, cash from financing. And cash from financing is the money raised through capital, money raised through loan, and payment of interest and payment of dividend, which is 0 here. So that means the business has started and they have raised money. Operations have not started giving cash yet, though there is a profit. One thing is very clearly visible. CFO is negative to a large extent because of credit sales. Because of credit sales. Now let us see CFI. It's a new business, okay? And as a new business, we can expect negative CFI. The company has invested in acquisition of plant, acquisition of know-how, and also acquisition of investments. They're diversifying their acquisition of assets. So negative CFI, negative CFO is actually a sign of a new company, a startup. In most of the startups will have negative CFO, positive CFF, and negative CFI. Positive CFF means you're raising money. Negative CFI means you're investing money. And negative CFO means the business has not yet started generating cash from operation. There may be profit, but because you're new business, so there is a credit sale. But this question remains, we need to examine why is PAT not same as the CFO? Or in other words, Let us see the indirect method of deriving CFOs. Indirect method of deriving CFOs. Let me put all the items together. Let me put all items together. We know that CFO will not be equal to PAT because of three important reasons, which we already mentioned here. Three non-cash items, non-operating items, and changes in operating current assets and current liabilities. Non-cash items, non-operating items, and changes in operating current assets and current liabilities. Now, for a short period, let us hide this. Let us hide this so that we can focus attention on the CFO, the direct method only. So we can see that PAT of the company is 149,000. 149,000. And PAT is not same as CFO because of non-cash. What is this non-cash item? Is a depreciation. So depreciation has been deducted while computing the PAT. Therefore, we are going to add it back here. Things which are items which are deducted in income statement, the adjustment means inversing that, reversing that. Amortization has been deducted, is a non-cash item, has been deducted because of matching principle. Now I'm going to remove that. So therefore, it is be added back. These are the only two non-cash items. Non-operating item, by default, interest in India in day 7 is treated as a non-operating item. We put that as a part of our financing decision. That may not be the case with US GAAP and other GAAPs. But in India, Ind AS 7 says other than banks, we will treat interest more as a non-operating, more as a financing cash flow. So interest paid is a non-operating and it has been deducted. Therefore, we are going to add it back. Dividend is an income, but it's not an operating income. Because it's not an operating income, we are going to remove that. And while computing PAT, this has been added, so therefore it is deducted. We are reversing that. Increase in credit sales or changes in operating current assets and current liabilities invariably are the adjustment for accrual principles and matching principles. Increase in salary payable, observe that. Increase in salary payable. Salary payable was 0. Salary payable is at the end of the year 25,000. This salary has been 25,000 in the income statement. That means during the period, salary has not been paid. Increase in payable is a reflection of amount expense not paid, but deducted because of accrual principle. Therefore, the adjustment is we are going to add it back. Similarly, increase in rent payable. Increase in creditors. This is an interesting item to be understood. Creditors and stock are connected to each other. Because when you purchase the goods on credit, it is creditors. By default, we'll use creditor as a trade creditors. So, to this extent, to the extent of 50,000, we have not paid money to the creditors. Therefore, I'm going to add it back. We can understand this better when we see the creditors and stock together. When we see this creditors and stock together. You can see the stock has been purchased 200,000 because there is no stock in the balance sheet. There is no stock on the balance sheet. So whatever stock you have used, you have purchased during the period and you paid only 150,000 because the creditors are still remaining 50,000. Increase in debtor is a very important item. Increase in the debtor by default means increase in debtors by default means the credit sales is credit sales. So here the entire sales is credit sales. Now if you sum them up, we get 199,000. So indirect method will show the same amount of CFO. The method doesn't matter. Whether it is direct or indirect, the CFO, whether CFO you derive through direct method or you derive CFO by indirect method, the result will be same. But the objective behind, in case of direct method, our focus is operating receipts and operating payments. In case of indirect method, the focus is why is CFO different from PAT? So that is the understanding of cash from cash flows. It's always important to understand the cash flows. Cash flows are critical for the survival of a business. To analyze the company, observe profit as well as cash. We'll continue our conversation on cash flow statement by getting into free cash flows and other performance indicators relating to cash flows. Thank you very much.